Everyone, I have a portfolio update I wanted to share with you all. And just to give you a little bit of background, I'm a pretty flexible investor. I'm not scared to make changes. This is a pretty small change, but essentially what I've done is I've just thought a little bit about one particular holding of mine and how it aligns with two of my investing pillars, growing free cash flow and a choke point in the economy. But it doesn't really line up with the third of building a company that's better for humanity, and really a needed, I guess another way to put that is it's a needed, necessary, very, very wide moat company. So that stock that I'm going to sell tomorrow, I have a trade pending, is Vici. So as you can see, I've got Vici. It's a 13% position. Again, I just started this, so I'm not, I've lost 0.2%. And I'm going to be replacing it with Canadian Pacific, CP ticker symbol. And that'll be a 10% position, and I'm going to increase my Toast position to 8% from 5%. Two main reasons I'm doing this. One is, again, Vici doesn't really align, again, from a stability, real estate, it's still a great company. It's actually really at the bottom of its range. I have it in my Roth IRA, kind of from a dividend stability standpoint. It could certainly have a decent return over the next 5 to 10 years. But I just, this portfolio, I really wanted to invest in companies that I'm not going to sell. I think that railroads, I also have CP in my Roth IRA, but railroads, Canadian Pacific in particular, really have almost indestructible moats. I mean, they have a significant barrier to entry. The rail network that they have is really second to none. They're a well operated company, and again, Toast. I started out with 5% position. I really like this company. I think it can be volatile. It might go down 50% from here, but in the long term, this company is so well positioned to be a leader in the payment space for restaurants, but also in making restaurants more efficient. I think restaurants are, one of those industries that really need kind of a shakeup. And Toast is, for very, very little capital outlay, they have the ability to add services and save restaurants money. Again, for a very little investment on their end. I think that's just going to continue to grow. They're going to continue to gain market share. They're a potential buyout candidate, I think, for sure, but I'm not investing for that. I'm investing in this company for the long term. So just want to touch really quick. I'm going to keep it to 5 minutes. I'm trying on the videos. Here is why I invested in Canadian Pacific. This chart kind of sums it up, or this chart with a bunch of different things on it. So red line, as you can see, goes up and down. That is the percentage change of revenues on an annual basis. You can see it's cyclical, and we are at the bottom of a cycle, I believe. All of these numbers point to that. Blue is the earnings per share, since December of 2012. Orange is operating margin, very, very stable. And then purple, the bar chart, is free cash flow. Again, CAGR of 22% over the last 10 years, 12 years. So this is why I'm investing in Canadian Pacific. Wide moat, excellent financials, stable company. I don't know if the stock market is going to do great over the next year, 3 years. So I want to be invested in companies that will survive. And that's it. Hope you all have a good night.